From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. A bit of calm to end a quarter of incredible gains, the best quarter for the NASDAQ, going back to the height of the pandemic. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, looking to close out a crazy Q1 with a quarterly gain. The Fed's emergency loans to banks point to stabilization, and Trump becomes the first former president to be indicted. We begin with the big issue, closing out the first quarter.
This year has all been about the whipsaw.
The volatility, I got to tell you, it is pretty crazy.
The bond market is the place where you see the volatility express itself.
The volatility that we saw in two-year yields over the last couple of weeks.
Two-year yields went from 5 to 4, and 10-year yields went from 4 to 3.5. It's whiplash.
We've had a series now of problems.
3 banks having been shut in the U.S.
Stories about Credit Suisse. Stories about Silicon Valley Bank.
Not only do you have the banking crisis that's weighing on confidence.
When you think about the Fed and all of these, they've still got a big inflation problem.
Markets and Fed are playing a game of chicken.
Whether it's rational or not doesn't really matter.
A lot of sentiment and a lot of kind of, emotions.
Pretty amazing.
We have never seen anything like this.
Joining us now to discuss Crossmark's Victoria Fernandez and Citi's David Balin. There is the key question: if we were going to rewrite our year-ahead outlooks now versus January 1st, Victoria, would you feel more confident or less confident about the road ahead?
Well, Lisa, I think, maybe 6 weeks ago, you and I spoke, and I was saying that we were confused about what was going on. Things weren't making sense to us. We didn't like the difference that we were getting in messaging from the bond market and from the equity market. And so if we come to where we are now, I feel like we're still there. We're still in that confusion. I've been calling it a foggy windshield, where we don't have a clear vision of what's going ahead of us. And I think it's still part of that. The bulls are going to be frustrated by the things that they know are more bearish in the market, and the bears are going to be frustrated by a stronger consumer, by the idea that the Fed is done, and so these more bullish risk-on moments in the market. And so I think there's still this tug-of-war going on here, and I'm not sure that we're going to be able to get a very clear picture until after May. If the Fed says at the May meeting that they're done hiking rates, or that they're at a pause, then I think you get a little more risk-on and you can write that story a little bit better. I'm just not sure that's the story that we're going to get. So for us, it's more volatility for the rest of this year. Same story we've been saying this whole quarter.
David, do you agree that we have to wait until May to have any clarity whatsoever, so we should just go back to sleep and wake up then?
No, I don't agree with that. I think that we actually have some clues right now as to what's going on. And those clues are in the bond market, right, where we've seen rates, come down precipitously. Part of that is associated with the banking crisis, right, and all of the rush to quality. But the divergence between, what's happening in the bond market, which tells us that a recession is more likely, that a slowdown is more likely, and the equity markets, which have stayed robust, I think is pretty considerable. And the evidence leans toward, that recessionary outlook. And the reason is that earnings projections are just simply too high for the environment that we're in right now. We think that we are probably seeing earnings estimates that are 10% or more greater than they should be. And that leadership in the market, in particular in equities, is really limited to the very, very largest firms, the highest quality names, and is not broad enough to make us feel confident that equities are in fact properly priced.
We'll get into exactly which areas you think are most mispriced. But honestly, a lot of people are pointing to smaller businesses, particularly with all the money that's been flooding into money market accounts. Barclays seeing another wave of bank deposit outflows, writing recent tumult regarding deposit safety may have awakened sleepy depositors and started what we believe will be a second wave of deposit departures, with balances moving into money market funds. They go on to say, we expect flows into money funds to grow by several $100 billion, heating up bank deposit competition. Meanwhile, we are seeing that deposit figure rise to $5.2 trillion of money markets outstanding. This really bleeding into this concern of what that means for lending. So, Victoria, from your perspective, how much are you watching smaller businesses as the most vulnerable in this type of environment?
Yeah, that's a great phrase to use, Lisa, the most vulnerable. And it does come down to these lending conditions that we're seeing right now, because we know as lending standards get tighter, as we get fewer loans coming in, that's M2 growth that continues to decline. That makes a contraction in the economy, and it flows through to some of the things that David was talking about. It flows through to earnings for corporations, because when they start to get tighter margins, what happens? Well, they're going to lower headcount, and so then that's going to flow through to the labor market. And we're going to start to see some of that shift as lending standards continue to get tighter and as loan growth goes lower. And so I think that's going to be a key factor to watch. We know that small businesses are the driver of this labor market and the driver of our economy. So it's going to be very important to watch. But I think we also need to watch what some of the larger corporations are doing in regards to issuing debt. You were just talking about yields coming down and rates coming down. We saw spreads widen tremendously. But over the last week, we've actually seen those tighten up. About 50% of the widening has already come back in. So I think there's a lot of different clues that we can look and see how the economy is going to look going forward.
David, you mentioned earlier you don't think that stocks have accurately priced in some of this softening, some of this restriction in credit. Which areas of the equity market do you think are most perhaps mispriced?
Yeah, well, I think it goes along two dimensions, right? One is company size, and one of the our industries, right? So if you take a look at industrials and metals and materials, for example, you could see real deterioration there. You could also expect to see deterioration in small and medium-sized companies, and the reason is that they're going to have to pull back, right, on their actual capital investment, across the board, and that is going to cause there to be just simply less spending, in those smaller businesses. And so for me, this is an area where when you combine all of these factors, right, the actual fact that the banking impact has been on small and medium-sized banks that'll reduce lending. When you take a look at the actual areas of the economy that are least likely to grow, and Victoria's right, where we're going to actually see job cuts. We've seen 300,000 job cuts announced in the information technology space over the course of the last 3 months, and those people have yet to come off of their severance pay that they're going to get before they become unemployed. So there's a lot of these factors that suggest that these weaker parts of the market, small and medium-sized companies, are yet to really report that their earnings impact.
The sort of mystery soup that we're talking about has created quite a conundrum for Fed officials who continue to speak and express their concern about what's happening, but really lack particular wisdom or insight into the road ahead. Boston Fed President Susan Collins speaking in an exclusive interview with Bloomberg's very own Michael McKee. Take a listen.
My assessment at the last meeting, just last week, with the summary of economic projections did suggest an additional rate hike, and then pausing and holding over the year. But I need to assess all of the data that's going to come in between now and when our next meeting is in early May. The new data that I've seen just in the past week has not materially changed how I'm thinking about things.
We have more with our own Michael McKee. Wonderful interview. And I've got to say, Mike, it's really notable to see the shift in tone. Frankly, the humility, the lack of certainty, and the data dependency at a time where we're not sure which data matters most.
Yes, and she pointed that out, that it's going to be difficult to make decisions because the data are lagging and they are all over the place. Let's look at some of the data that we got today that we talked about during the interview. Personal income up 0.3%, half of what it was in January, and spending only 0.2%. Susan Collins saying she was expecting the economy to slow. That's what the Fed is trying to do, so it may not be too bad a news. Excuse me a moment. The PCE headline numbers, half of what they were on a monthly basis, both headline and core, up only 0.3, which would suggest progress, although she said that it is hard on a month-to-month basis to say that this is a definitive trend because the numbers are somewhat noisy. And then, Lisa, of course, we have the Fed's favorite indicator, Jay Powell's PCE Core Ex-Housing Index, and you can see there was some progress made. The month-over-month number is only up by 0.3 rounded off, and that keeps the year-over-year number elevated, but not as bad as it had been in prior months. So we're looking at some progress there. The one interesting thing, of course, is that the markets are still pricing in 4 rate cuts this year. And I asked Susan Collins about that, and she said different people have different views. We'll have to see if that bar chart changes or flips direction as time goes on, but she said she's committed to keeping interest rates at a high level throughout the year, at least unless the data tell her something different.
Yeah, and she was keeping the line. That's basically kind of what we heard from Fed Chair Jay Powell, that wasn't his view, or it wasn't Susan Collins' view. Michael McKee, thank you so much, and really wonderful interview. Don't miss Mike's follow-up exclusive interview with St. Louis Fed President Jim Bullard on Monday. That's 8:30 a.m. Eastern on Bloomberg Television and Bloomberg Radio. This question around a market that is convinced of rate cuts with a Fed that still wants to perhaps pause rate hikes, but really hold right there, really has posed an issue for markets. Victoria Fernandez and David Balin still with us. David, how much do you lean into this view that the Fed is going to cut rates by the end of this year? And does it matter? Because either way, it means that there's either a deterioration in the economy or strength in the economy one way or another. And it's not necessarily all about the Fed.
Well, in many ways, it really is, all about the Fed, because when you listen to Susan's interview, which was excellent, I think that, one of the things that was sort of unsaid is that the Fed has been unable to keep peak rates for more than 7 months at a time. And the Fed's ability to tolerate unemployment is very low. Even during the Volcker era, that was the case. So what we expect to see is when we finally see a deterioration in employment, the Fed, I think, is going to be very inclined to become more accommodative based on historical precedent. If they don't choose to do so, what we're also not saying is that when you look back, it takes 12 to 18 months for the full impact of Fed policy to actually hit us. And we're actually in that time right now. They began these extraordinary rate rises, more than a year ago, and we're about to get the full impact. I describe it this way: 2 Advil for a headache, 4 Advil for a migraine. When you take 16 Advil, right, you could have side effects. And that's what we saw with the banking crisis, and we're likely to still see, that rates have never gone up this fast in history, right? 4 3/4 of a point, hikes. That is highly unusual. And so the idea that we're going to have this soft landing, that everything's going to work out okay, seems a little suspicious to me, and a little suspicious to the bond market. That's why I take the bond market's pricing in not necessarily the timing of the rate decreases, but the fact that they will occur. I believe that they will occur, and they will occur once we have employment really deteriorate, which is what's in front of us.
Victoria, your view?
Yeah, so I look at what the Fed has said to us, and I look at what Susan Collins said, and I'll be anxious to hear what Bullard says next week as well. And they're telling you that they still think there's more work to do. So all along, over the last year, the market has not believed the Fed. They have lost confidence in the Fed. They wouldn't listen to what they were saying. And as Powell and the Fed continued to do things, the market seemed to come along a little bit. So yes, the bond market has priced in rate cuts at the end of this year. I'm just not 100% on board that we're going to see that. I think we get a mild recession coming in maybe third quarter of this year as all of these previous hikes work their way through. Yes, we do have those long and variable lags that we're waiting on, but I don't think the Fed is going to be quick to cut rates. They have had a long battle trying to get inflation down. I don't think they're going to flip that switch as quick as the market is pricing in right now, and we'll probably see some of those rate cuts get priced out of the market, giving us higher yields as we get closer to the end of this year. I do think we'll see rate cuts next year. I think we'll have a mild recession. The Fed will eventually cut rates. I just think the timing is going to be a little further out than what the market's anticipating right now.
Victoria Fernandez, David Balin, both of you are sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Katie Greifeld. Katie?
Well, you have stocks linked to former President Trump absolutely soaring this morning. Let's start with Rumble. It's a video sharing platform with a conservative bent. It happened to report earnings yesterday that beat expectations. All of that is lifting the stock. And of course, we have Digital World Acquisition Corp. That is the SPAC that's taking Trump Media public, also surging up about 8% or so. Definitely just a few of the names to keep an eye on next week, with Trump expected to be arraigned as early as Tuesday.
Katie, thank you so much. Coming up, former President Donald Trump indicted.
I think this is an outrage. This will only further serve to divide our country.
That conversation, as well as the potential policy implications, coming up next.
Are you worried this will further divide our country, the indictment?
I have no comment on that.
Mr. President. Possible protests in the wake of the indictment?
No, I'm not going to talk about Trump's indictment.
Donald Trump becoming the first former U.S. president to be indicted. The arraignment coming as early as next Tuesday. The specific charges, however, are still under seal. The former president calling the indictment, quote, political persecution and election interference at the highest level in history. Lawmakers are already taking sides. Speaker McCarthy saying it's, quote, an unprecedented abuse of power. Democrats welcoming the news. Representative Maxine Waters tweeting, quote, sometimes justice works. For more, Bloomberg's Anne-Marie Hordern joins us here in New York. Anne-Marie, how much is this really dominating the conversation in Washington, and how has it changed the narrative as it had been going?
Well, Lisa, what really it's doing is just pulling the oxygen out of any conversations you're going to have about policy or anything regarding the debt ceiling, negotiations that are ongoing right now. You saw the president walk down a line of reporters, and every question was about former President Donald Trump. And you could see that that is going to be every single question, whether it's at the White House or in Congress. So that's where the focus, of course, is, because, as you mentioned, this is unprecedented. And not only is Donald Trump a former president, he's also a 2024 presidential candidate. And that is why you're going to see really party lines harden because of this. And not just party lines in terms of Democrats and Republicans, but I also think this is going to have further division within the Republican Party. The former president has about 30% of the Republican Party, and this kind of moment is something he revels in, because already he's able to go out there, say that he's a martyr, really pump up his base. He's talking about protests because of this, and of course he's asking for campaign aid finance dollars off of this.
Anne-Marie, just quickly here, Joshua Green wrote a terrific piece for Business Week talking about how there really isn't a corollary in the U.S. history, but there are corollaries in the world, including, for example, people in a number of developing markets, leaders who do not step away from allegations but lean into them. Internationally, is there any sense of how this shifts the conversation?
I think what you hear, especially from the likes of European allies, you saw the former president, Donald Trump, take a very U.S.-centric push into foreign policy world. And that whether that was China or the Middle East, what you see President Biden do is they really want a multilateral approach, not unilateral. And what European leaders are concerned about is potentially if the former president does become the GOP candidate and potentially wins, how they have to shift after they built up all this, almost more of a teamwork approach with the Biden administration. There are those concerns.
Anne-Marie, thank you so much for all your reporting throughout the morning, and we'll look forward to it this afternoon. Victoria Fernandez and David Balin still with us. From an investing standpoint, how much, David, is this just noise, and how much is this something that you have to take into account that could potentially affect, if nothing else, currency landscapes and international relations?
Well, I think that the big concern is really not so much this the indictment, so much as the question of what happens around budget negotiations and the debt ceiling. You know, we tend to downplay, because of all the historical precedents, the fact that this will get resolved properly, and we certainly hope that it will in markets. But there's no current pricing that that it really assumes that there'll be a default or even the threat of a default in markets right now, and the politics associated with these events can in fact spill over and be expressed through the debt ceiling issue. So that, to me, is the largest risk that they tie one to the other.
Victoria, do you get that sense that there could potentially be some greater pressure, some greater risk that there is a debt ceiling debacle, a debt default that does become really important to markets?
Well, obviously, the debt ceiling issue is going to be important to markets, and we've heard a little bit more this week about some compromises potentially. The Republicans are putting out some ideas that they have. President Biden had put out his ideas, so we'll see if they're able to come together, if McCarthy and Biden can come to a conclusion there. But it's going to be a long, drawn-out battle, and I think we're going to go to the brink. I think we'll probably actually cross over the X date that we're given, which right now seems to be somewhere around July or August. I just think there's going to be a tremendous amount of partisanship that is going on, and I think the Trump indictment is going to fuel some of that as well, and that's going to push us to the limit. That's where we're going to get volatility in the markets. That's where we're going to get concern on the dollar. I wouldn't be surprised if we saw rating agencies come back in again like we saw previously and have some discussions on what that means. So I think there could be potentially a lot of volatility volatility within the markets due to the debt ceiling, but the Trump indictment just adds to the fuel of the partisanship associated with that, when I was actually hoping we might get some cooler heads prevail and come to an agreement. Doesn't look like we're going to get that.
And this really speaks to something that Mark McCormick over at TD Securities has been talking about, how much of the decline in the dollar, the weakness that we've seen so far this year, and certainly even over the past turmoil, is due to a lack of U.S. exceptionalism. David, do you believe in that story that some people are putting out there?
Well, I don't think it really has anything to do with a lack of U.S. exceptionalism as it does to the fact that this is the third, largest rally in the dollar that we've seen over the last 50 years. And that rally is coming to an end for structural reasons and other reasons. And I'll give you two. One is right now, when we saw the banking crisis, we did not see the typical rise in the dollar, which we would normally see because of the fact that the dollar was already so expensive. And then secondly, when we take a look at what's happened overseas, the European banks themselves are far healthier, have a better deposit ratio than we see in the United States. And all of this suggests that the U.S., is at peak interest rates and the peak interest rate differential to the rest of the world, and that we're actually now going to see, a reversion to the mean for the U.S. dollar, none of which I think is really related to the political events that are taking place right now or the end of U.S. exceptionalism in any way.
David Balin, Victoria Fernandez, to both of you, thank you so much and have a wonderful weekend. Just want to give you a sense of where we have been in this quarter as we get prepared for the opening bell. The tech stocks are poised for their best March since 2010. Tech stocks are the best quarter since 2020. Yet bank stocks, the biggest laggard, are wrapping up their worst quarter since 2020. Coming up, the morning calls, and later, the case for duration, why JP Morgan's Bob Michael is doubling down on government bonds, even the longer tenors. That conversation happening around the opening bell. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. A constructive tone to end the quarter, taking a look at a potential 0.4% gain in the S&P. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Citigroup calling McKesson its top pick in the pharma sector, expecting shares to act as a safe haven in the challenging environment. Next up, Barclays upgrading advanced auto parts to equal weight, highlighting the stock's notable underperformance. And finally, Loop Capital downgrading JD.com to hold, growing more concerned about the highly competitive e-commerce landscape. Coming up, stocks closing out a volatile Q1 with another quarterly gain. We've got JP Morgan's Bob Michael joining us at the opening bell on his call for potentially the entire yield curve below 3% in the next 6 months. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of trading with a constructive tone to markets to end a very constructive quarter. Some of the best and some of the worst quarters since 2020 for a number of different asset classes. Russell doing better than good, up 0.7%, as you've got that bank sector really supporting it. S&P futures up about 0.25%. In the bond market, a constructive tone, although it's sort of not a lot of drama after a pretty tumultuous couple of weeks we can have right now. The euro weakening versus the dollar. 10-year yields 3.5%, and crude marginally higher here as people take a look at the potential for maybe a soft landing, maybe faster growth. I can never figure out the crude market, and I don't think a lot of people can right now. One sector to watch at the open is big tech. The Nasdaq 100 closing out its best quarter since 2020. For more, Bloomberg's Ed Ludlow joining us now from San Francisco.
Yeah, good morning, Lisa, and happy Friday. Best quarter since that June quarter of 2020, but the second best quarter overall in the last decade. You look at the contribution of mega cap tech. That's a really interesting contribution, in part because many of those names that have had strong performance, particularly in the back end of the quarter, are trading at multiples and forward 12-month earnings above the Nasdaq 100. In fact, it's only Alphabet, parent of Google, that's trading at a discount to the main index right now. I think there is some concern. You referenced the Goldman Sachs note of 24 hours ago. We're still asking ourselves what happens if we go into a recession. And if we go into a recession, what happens to growth names in particular that are low margin or profitless, and how we might value those, because then growth expectations going forwards will come down. The mindset around the Fed also seems to have changed when we talk about the technology sector. Reading across the research this week, we kind of moved on from the rates narrative. We accept that higher rates discount the present value of future profits, but we also look at the impacts of the Fed's balance sheet and what they've done from an easing perspective over the last 7 days or so. That relationship with the short end, the policy-sensitive end of the curve, and the NASDAQ 100 still important. We still track it. One other data point that I want to pick out in today's Tech Watch column: investors have been piling into tech. Those that have been fleeing tech are insiders. If you look at the data tracking insider share sales, you have to go a pretty long way back, the end of 2021, since the flight in executive share sales within the sector are that high. Final chart there on your screen shows the lingering impacts of SVB. Look at the Goldman Sachs non-profitable tech basket, the white line, and its underperformance of the kind of more premium names in the S&P 500 tech sector. Good quarter, though. What did you call it? Constructive quarter.
Ed Ludlow, thank you so much for that. Banks, as you mentioned, Ed, going in the opposite direction with the KBW Bank Index set for its worst quarter since 2020 after snapping a 4-day winning streak. Katie Greifeld joining us with more. Katie?
Yeah, not quite a constructive quarter if you look at the banks. If you look at the S&P 500 overall for the past quarter, the 4 of the 5 biggest losers in the S&P 500 were banks. As you can probably guess, right down at the bottom is First Republic, down a whopping 89% this quarter. Still a lot of questions over this bank despite that $30 billion rescue package that came from some of the bigger banks. But what's interesting is that it's not just this quarter that regional banks have really come under pressure. If you look at the relative performance of KRE, that's the regional banks ETF, versus XLF, which tracks the sector overall, you can see that for 2 straight quarters, regional banks have been underperforming to the tune of double digits. And this quarter, down about 19% relative to those bigger banks. That is the worst relative quarter of performance since 2009. Not a size and scope that you love to hear. So even though the worst case scenario right now seems to be avoided, or at least fears about it have gone away, Barclays was warning yesterday about a second wave of deposit outflows coming. As you can see, deposits have been growing steadily since the pandemic. We're going to get an update, of course, from the Fed this evening at around 4:15 p.m.
Katie Greifeld, thank you so much. That is the kind of data points that people are looking for at this moment. Joining us now is someone who has been spot on for a while with being a little cautious and leaning into duration. Now, perhaps more so than ever before, JP Morgan's Bob Michael joining us here on set. I want to start there. We talked just a couple weeks ago, it feels like a lifetime ago, about leaning into duration, about even more so stress in the banking system. Confirms your view. The markets come toward you. Are you doubling down? Do you feel it even more so, or are you starting to question it?
No, I'm not questioning it at all. We're actually looking for an opportunity to add more duration to our portfolios. We're looking at the front end of the curve, 2- and 5-year treasuries. We're expecting a 50% backup from the rally that occurred in March. It puts the 2-year somewhere around 430, the 5-year somewhere around 380. We'd be a buyer there. We think recession is inevitable by the end of the year.
What's the nature of that recession? And I ask this because it seems like, if not a soft landing, that it's not that deep of a recession that we can get through, at least by virtue of where risk assets are priced.
Well, it's the central banks and the aggressive amount of tightening they've done. And it's not just the rate hikes, it's also quantitative tightening. There is a reverse multiplier for that, and that's sucking credit out of the system. I think actually we're transitioning in central bank speak from long and variable to cumulative and lag. The long and variable hit the regional banking system. I think over the next couple quarters, we'll see the cumulative and lag pound away at the economy.
You talk about how you expect really an opportunity within the 2-year yield at a time when Fed officials keep saying, we're not going to cut rates, we're going to pause. You take the other side of that.
Yeah, the Fed officials are saying what they have to say. They're hawkish on inflation. They have to be. They were a little slow off the mark, and for the last year, they've been scrambling to catch up to inflation. Everyone's talked about Arthur Burns and not making a mistake of declaring victory too early. They've won. They've already broken the back of inflation, and I think they probably know it. There are the obvious things. You look at oil's come down 40%. You've had a banking crisis. Banking crises aren't usually accelerated or aren't usually associated with an acceleration in inflation. They're disinflationary, if not deflationary. You look at personal consumption expenditures core today, you've had a 0.3. My guess is next month, it's not a 0.4, it's a 0.2 or a 0.3. Then there are other things to look at. We look at the National Federation of Independent Businesses that survey small businesses. Their price plans for the next 3 months are the lowest they've been since the first quarter of 2021. And even Fed officials have shifted themselves. 17 out of 19 at the December meeting thought the risks were to higher inflation. In March, that dropped to 11 out of 19.
So if that's the case, when do you start to think, okay, we may be getting past this, we may start to see the pain come in, and then we could start moving toward the other side where perhaps we end up with risk assets rallying once again and leaning into perhaps riskier credit?
Well, I actually think the next quarter we could see risk assets rally. Having been an investor through the financial crisis and looked at that seminal moment when Bear Stearns and JP Morgan combined under regulatory supervision, I might add, the next quarter was great for markets. Equities went up 15 to 20%. High yield credit spreads retraced a quarter. And then the bottom fell out. I think the ECB also raised rates in July 2008. You could have a feel-good period, and then the reality of the cumulative and lag catch up and slow the economy down. I actually think the data we're looking at it's irrelevant. It's not important. The data that's relevant is the data we're going to see in September.
So the saying, you can remain right, or you can't remain solvent as long as perhaps you may be right, that there is some sense that even if you have the correct idea later on, you have to get the now right. So do you lean into a risk rally that you know will be fleeting? Absolutely not. I think if we've been taught anything this past month, you may see it coming, you may not, you don't know exactly where it's going to hit, but once it hits, whatever you own, you own. And you have to hope that you own the stuff that recovers. All the regional banks that their bond prices went down, the survivors went up, and the others are headed to restructuring 60, 40, maybe 30 cents on the dollar or lower. You believe that the entire yield curve could get to 3% or even lower by this summer. Where will it end up by next year? What's sort of the normal yield curve going to look like? Well, we do think the Fed will start cutting rates in September. And I know some of the markets pricing for that, but it doesn't look like the coupon curve is actually pricing for that yet. I think the Fed will get down to, I don't know, 2.5% to 3%. Maybe the 2-year gets down to about those levels. And the 10-year, depending how long the Fed stays at those low levels, could start going up for 3%. I think that's then. I think for now, I just want to use the next quarter to continue to comb through our portfolios and try to make sure that the known knowns, that we have them in our portfolios, that we have the best quality borrowers, that where we know there are problems in commercial real estate, we comb through our commercial mortgage-backed securitizations, that where we know there's a problem with middle market corporate loans, where they're rolling them over at 2 to 3 times the rate they were putting them on a year and a half ago, that we have the survivors there. And let the others, I don't want to own those. Spring cleaning with Bob Michael. That's sort of what I call it. This feels like a spring cleaning exercise. Bob Michael, you are staying with us. Coming up, a historic day for America.
We haven't unsealed the documents, so we don't know for sure what the allegations are. If they're what we think they are, my take would be this is a fairly weak case. This is just the appetizer, the hors d'oeuvre. Bigger stuff is yet to come.
That conversation still ahead with Terry Haynes of Pangea Policy.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Society of Lloyd's CEO Burkhard Kies. That conversation at 11:30 a.m. Eastern, 4:30 p.m. in London. This is Bloomberg.
We haven't unsealed the documents, so we don't know for sure what the allegations are. If they're what we think they are, My take would be this is a fairly weak case, a novel legal theory relying on a convicted felon. The next three are huge. The Georgia vote, the taking of secret documents, and of course January 6th. This is just the appetizer, the hors d'oeuvre. Bigger stuff is yet to come.
A Manhattan grand jury indicting Donald Trump, the former president, expected to be arraigned as early as Tuesday as he continues to deny any wrongdoing. Bloomberg's Simone Foxman joining us now from outside the Manhattan District Attorney's office. Simone.
Yeah, that arraignment would take place here behind me, as would a potential mugshot, fingerprints of Donald Trump. That is what we know at this point. What we don't know is what these exact charges are, because they remain under seal and will remain under seal until that arraignment actually takes place. We believe they have to do with hush money payments made to Stormy Daniels back before Trump was elected in 2016 by Michael Cohen. But the falsification of business records, which is the theory behind this, is not a felony in and of itself. It's just a misdemeanor. So this would have to be perhaps tied into other potential crimes, and we'll see how that plays out potentially as soon as Tuesday, Lisa.
Simone, thank you so much. Pangaea's Policy's Terry Haynes joining us now. Terry, I'd love to get your thoughts on what just has transpired and what the implications are for Washington and the policy road ahead.
Good morning, Lisa. Three things. One, I think this is sad for the country because the country deserves better than the kind of endless bread and circuses that we've had with the Trump show and people trying to take him down all these many years. I think it's sad for the legal profession because this gets looked at by the country at large as politicized justice with a weak case. I mean, you've got polls showing that 60% see this as politically motivated, and 67% think Trump's payment was a personal expense. You know, and I'd add to that, you know, the idea of a developer in a large city fudging his or her books. I mean, you know, that's pearl clutching time. I'm shocked to find out that happens. And, you know, finally, I'm going to be a little non-consensus on the politics. You know, you've heard the consensus, but I think what ends up happening here is, first, this causes more Trump fatigue in the country generally, and that helps DeSantis because that's part of DeSantis's pitch, is that, you know, we need to move on past this, which most of the party does. Secondly, this may well appeal to the Democratic base, but I think it largely turns off swing voters because they just think it's more of the same. And thirdly, it actually allows Republicans to keep pounding on alleged Democratic sins, including Biden's own treatment of classified documents. So, you know, I think this is not quite what the consensus has it to be.
Terry, do you think that this increases the odds that the U.S. does default on its debt, or at least bumps up and then crosses over the debt ceiling?
I think that's a very smart question. And, you know, I've thought, as you know, I've been very non-consensus since right after the elections last year that there's about a 40% possibility of default. I think they end up pulling back from it. But, you know, some of your other guests said this morning, and as I say, I've been talking about this for months, you know, there is going to be a lot of brinksmanship and there's going to be a lot of volatility in the market as a result of it. I think what it ends up doing, frankly, is focusing Republicans in particular on the idea that what they need to be doing here is walking and chewing gum at the same time. They've all run, you know, on local and state platforms, and those local and state platforms include different sorts of accomplishments. You know, just this week, for example, they've been doing this energy bill that some people characterize as a slap in the face to the administration. And what they need to be doing is a lot more of that. And I think they're going to focus on business as usual and trying to roll some stuff out instead of getting all caught up in the Trump show.
Terry Haynes, thank you so much for being with us. Still with us is Bob Michael. And Bob, I want to move forward on the idea of not just debt ceiling debate, but also we're still dealing with questions around what actually transpired with respect to banking stresses and how much deeper it goes. What would you hope to see the government do at this point to kind of shore up your confidence that this doesn't bleed into something bigger?
Yeah, I think, first of all, the regional and community banking system is vital to the U.S. It extends credit into middle America, and we need that. And I get a lot of questions from our clients about it. I think what we're seeing is the stresses are still there. I look at the Fed data. I actually saw borrowing at the bank term funding program go up by 10 billion. Money market assets went up by 66 billion. That money's coming from somewhere, and it reflects still a lack of confidence in the regional banking system. This reminds me of the S&Ls back in the late 80s, early 90s. When there were a lot of them, they ran into similar problems. Ultimately, the government had to create the Resolution Trust and Resolution Trust Funding Corp, which created securitized debt for investors to invest in. And that created a consolidation of the S&Ls at the time, and I think a relatively healthy banking system. I think we're actually going to need something similar to that now. I think we've got to go through a period where we reorganize the regional and community banks, put them on their own stable footing, and restore confidence again.
As an investor, as part of the shadow banking system that everybody talks about, you know, as we don't understand it, but it's there, you're there, could represent it. How do you play at a time when perhaps some of these banks are pulling back? Do you step in? Do you say, you know what, some of these banks are beaten up? Do you play which ones you see as an advantage, an opportunity?
Well, there are those that have very good footprints. I think they're called now popularly the super regionals. Those make sense to us. Maybe that's the blueprint going forward. And then there are a lot of others that we're just concerned about. And we wonder, how does confidence get restored to them? I don't think the government can permanently backstop them through the FDIC. There's got to be some sort of reorganization coming up.
What about the creditworthiness of the companies that you lend to, both public and non-public? Do you feel that perhaps there is a risk that they do become more vulnerable to defaults, to other distress, as banks pull back?
Everyone's pulling back. The central banks are tightening credit. Now the banks have to tighten credit, and non-bank lenders ourselves. I did 5 client calls yesterday, and all of them were about, what do we own in our portfolios? And as you know, we've been as conservative as we could be, and they're drilling into specific line items and wanting to know. If they're doing it with us, they must be doing it with everyone, and that's going to cause private and public investors to pull back too.
So where do you have to see, because you said that you think that there could be a rally in risk assets, so you're talking in particular about credit, but also equities in the next quarter before the declines come into place. What kind of yields make sense to you on average for, say, high yield, given the default risks that must be implied by a lack of credit?
Well, I think if I can get a running start into this, we had years of excess free liquidity in the system, and it bubbled up in a lot of places. It didn't belong, and that's what's being sucked out of the system through quantitative tightening, and we're naive to assume there's not going to be pain. When the pain hits, when we get into recession, we're expecting high yield credit spreads to go to a minimum of 800 over. I know they're about 500, but I actually can't find a recession where they didn't go to a minimum of 500 over. Where they're priced now was the one soft landing, and that was 1995.
What kind of default cycle are you looking for with respect to that type of yield scenario?
Well, defaults could get up to around 6%. I don't know that the public high yield market will go much above that. 94% of it will be money good. Even the worst of high yield cycles, when defaults got up to 10%, 90% of it was money good. It didn't stop the rest of the market for repricing. There will be risk aversion, there will be flight to quality, there will be de-risking, there will be holders of lots of other problems, whether it's in private capital, in their equity portfolios, or even in the public bond markets. It creates de-risking.
Just real quick, which is more attractive, private or public credit right now?
Public credit.
Bob Michael, thank you so much for being with us. Really appreciate it. Bob Michael there of JP Morgan. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary. This is Bloomberg Markets, the open, here with a look at markets closing out a quarter of gains, of pretty substantial gains in certain sectors. You could see up about 0.5% as the S&P and the Nasdaq up about the same. The Russell outperforming yet again with a 1% gain. If you take a look at bonds, not really doing much. Yield slightly lower as people calibrate after a pretty whipsawed couple of months. But I want to take a look at quarterly results. We have seen the Nasdaq deliver the best quarterly return going back to 2020 with almost 20% gain. The S&P up by 6%, and you can see the KBW Bank Index down almost 20% for the worst quarter going back to 2020. Time now for the trading diary, what you need to be watching this week. The UMich Sentiment Survey coming at the top of the hour. ECB President Christine Lagarde speaking at 11 Eastern, followed by Fed Speak from Williams, Waller, and Cook. Looking ahead to next week, ISM manufacturing numbers on Monday. Cleveland Fed President Loretta Mester speaking on Tuesday. Jim Bullard on Thursday. Finally, the main event, the U.S. payrolls report falling on Good Friday. We will be here to break it all down. This was Countdown to the Open. This is Bloomberg.